Hey everybody, hey traders, happy Thursday. Welcome back just after 3 p.m. on the 13th of March. Welcome to the final hour live session. Markets in the red today, not unusual. For the last couple weeks we've seen it. Let's talk about some key levels. We did have some defense on the Tuesday low. CPI data came in better than expected. PPI data came in better than expected. Market still decided to test the lows. The next major catalyst is going to be the Fed next week on Wednesday. I wanted to kind of plant the seed. Not that I'm calling for a crash. I don't want there to be a 20% correction, but I also want to wrap your head around the fact that it could happen and the technicals do make sense to get there. So I wanted to show how and why and where, and it's right in here. So it's not that difficult. If you look back to this 2020 low during COVID, and you connect the lows from the bear market in 2022, as well as the pullback we saw in 2023, that would be our potential technical support somewhere in here. Now, I do think even if we are going to go up from here, whether we go all the way back to all-time highs, this trend line is going to be something that is found eventually. But, given the fact that we have had our, 10+% correction in the S&P, we'll check and see what the exact number is, but it's over 10% with today's fresh low. NDX, let me go back a few weeks here from recent highs to low. So this is NASDAQ, has been down about 13.8% from high to low. We go to the SPY, same thing. This is right around 10% with some fresh pokes today at the bottom. So we have the SPY right around 10.3%. Okay. So I'm looking at important levels to break. Some of the crazy stuff I'm seeing in the markets right now as far as sentiment goes. I said this morning during some live sessions. Sentiment is not a signal. Okay. I think it's anticipation. I think it's an opportunity to look that this is where people are crowded, and usually the market doesn't reward that. In the case that the market is rewarding the crowded trade, which would be the bearish side, we are sitting very close to 1-year bearish highs, which was the week ending in February 226. This week it printed on 312, so that would have been yesterday, and we had a 59.2. So within the last 3 weeks of this AAII sentiment survey, you can see that investors are positioned pretty bearish. Their outlook on the market is pretty bearish, and typically this is a contrarian signal. So that's quite extreme. Let me see. I'm actually curious how often. Let me go to historical sentiment data here. And how far back can I go? Let's go download historical data. I think I've downloaded this before, but all right, let's see what this shows. I'm actually going to try to do a filter on this and see bullish 8-week move, bull bear spread. Okay. So what is our spread right now? Right now we have about I'm guessing roughly like a 40. We got a 40 spread. Bull bear spread. 23. Weird. Okay. This isn't giving me exactly what I want here. So I was going to try to filter. Well, anyway, I was just hoping I could see a little bit more. Their sentiment towards the market is about right. 35%. Too bearish, 32%. Too bullish, 24%. No opinion. Got it. I'm curious where investor sentiment is as well. I'm going to try to do some digging in the JP Morgan has a Q1. I think it's called State of the Markets. I'll give that a read today and tomorrow and see what I can glean from this. Sentiment indicator, sentiments, blah, blah, blah. Okay. So we'll take a look. All right, that's one thing. The other one I was looking at today is this was trading, or this was showing a 21 earlier. Now it's a 16. So we have additional fear gauge, and this is extreme fear. Momentum, market momentum is extreme fear. Okay, this is a 125 moving average. You know, I like the 200, but the 125, the 100, the 100, 200 moving averages are pretty common, kind of industry standard. Stock market price and strength, extreme fear. Breadth, extreme fear. Put volume is growing. You know, we obviously put in some lows here, that July to August 5th bottom, as well as that bottom back in April. I'm a bit surprised through December. I mean, I guess it wasn't a huge deal in December because it was kind of a holiday trade. But December 18th, when the Fed, you know, kind of smashed the market down for the day, and then we had a lot of like topsy-turvy roller coaster rides through the next like 2-3 weeks of the holidays. But I think this is something we shouldn't ignore. So we are back into levels that we probably haven't seen since September of 2024, which is a little post-Labor Day sell-off. So watching that area, and that would be our August 5th level, and that would be our, that's April of 2024. Surprisingly, the put ratios were even higher through April than they were in August. But I think that was also because the market had a quick decline over a weekend, and it just was met with just buying, like vicious buying on Monday morning when the market opened after that gap lower. That was August 5th. So we are coming up into some levels where we pointed out some pretty nice lows. Market volatility showing some fear. Safe haven demand showing extreme fear. This is the 20-day stock and bond return showing that correlation is finally breaking down. Bonds are not necessarily up, however. So U.S. 10-year isn't really moving. So I mean, I don't know if this is a great thing. If everyone wants the 10-year to go lower, I'm one of them. But if the 10-year goes lower, that's probably coming on concerns that we are really going into a slowdown. So all I'm saying is this: take a look at the charts. That's all I'm saying. All right, because we are through the 200 moving average. If you look left on this chart and you compare these lows from COVID to the end of the bear market in 2022 into the Q3 correction in 2020, this would have been a Q3 correction in 2022 as well. Or no, I'm sorry, this would have been 2023's move. And then 2023 bull market continued, got back up to highs into 2024. And then we had our, you know, little stretch and hiccups into 2024, right? But connect the dots. 1, 2, 3, looking at potential support in here. That is around a 20 to 22% correction from these recent all-time highs. So we are going to see how resilient the market is. If there's any pullback, if there is not, then potentially a 20 to 22% correction. So I'm bracing and hedging for a trade this year that is going to be able to profit from this area. All right. So I'm risking about 1% of my account to potentially make about 6% on these trades. So if I get down to this level, I'll have anywhere between 4 to 6% of profit. You know, and you might look at that like, well, Chris, if it's going to drop another, you know, 10%, would you just, well, I've got to be like bearish the entire portfolio if that's the case. And, you know, obviously I can sprinkle in trades. I can still trade options. There's still ways to generate income. But if I'm looking at a, you know, roughly 1% risk to make 6%, I mean, that's a good hedge in my opinion. Okay. So just wanted to note that, like SPX, connect the dots, go to SPY, connect the dots. You can see the same thing here, right? So connect the dots on SPY, go to the Qs. Qs might be a little bit different, but let's take the 2020 low. So that's a much larger and much bigger outer trend line. Connect the lows from COVID to the end of the bear market in 2022. Okay, so volatility on the NASDAQ could obviously get a little bit more extreme, and we would come back into, you know, all-time highs in 2021. That previous all-time high would offer some support, but that's probably somewhere in, let's see what that correction would be. That would be around a 25% correction. Wow. So that's already like a 24 to 25% correction if we come back to the previous all-time highs in the NASDAQ. If we come to this outer trend line, we'd be talking, very similar to what we had back in 2022. Actually, that was a 35% correction roughly, and potentially lining up same thing with this trend line around 36%. So, um, yeah, it could be at gnarly out there. All right, Dow, a little bit different, but connect to lows, connect to lows. Your Dow COVID crash into the lows right there. I mean, that's pretty good structure if you ask me for a trendline bounce. The Dow would actually be a little bit less volatile, and percentage drawdown should be a little bit more contained, but this would be a previous level around 370. And let's see what that correction would be. Dows did not make recent highs in February. So we look at a correction around 18% in the Dow. So if we get below this trend line, back above the trend line, and again, that's only from what looks to be a correction. I think the worst case scenario would be that this market doesn't stop, right? Like we have this correction. I mean, I think with the kind of natural ebbs and flows of the market, having a 10+% sell off, if it gets to 11, 12, 13, okay, I'm still looking for a near term bounce. But I think even a near term bounce is probably going to be met with some additional resistance. So if the market is going to continue to slide lower, then yeah, I think we have a pretty reasonable bounce from here. It still is not going to be fun. That would be a very painful trade to the downside. So I just need to be mindful of that. All right. So we'll see how this plays out. But this is why, it's not unreasonable to think we could have a 20% correction in the S&P, maybe a 25 to 30% correction in the NASDAQ. Even the Dow could get close to 20%. Russell, I would put Russell on its own little island. It's already trading down 20%. I did close out some trades this morning. So I had some winners that I closed out for next week's expirations. And from the 21st and 28th, I closed out winners on Microsoft, Google, Walmart, Apple, Airbnb. Intel was a nice trade that I literally took yesterday during final hour. I closed that trade today. That was a 1550 debit, and I closed for 1710 credit today. So that was a quick turnaround for $1.60 per contract. So that was a nice little winner. Closed out a winner for Amazon. Closed out a winner for BCS. Closed out a winner on IWM. I rolled some share. I rolled actually a collar on Coca-Cola. Actually, it was just a covered call. So I did a covered call roll. And Netflix is looking good for next week. XLC is looking good for next week. XLE is looking good for next week. So next week, I'm looking at Netflix. I'm looking at XLC. I'm looking at XLE. And I'll keep a close eye on how those play out. Anything else? Nike should be a winner for next week as well. I closed out a winner on AT&T today. That was just a call option that was up a few $100. I think it was up like $300. So closed out a call option there. So even through, hitting some fresh lows, still have some winners, still continuing to trade. That's part of the game with diversification, is that you just continue to trade. This is why trading small. This is why risk capital is so important. This is why risk management is so important. I'm going to keep taking stabs to the market. I think the most important thing is that I maintain at least some adequate buying power, and that's why I want to be fairly aggressive on protecting profits. I will take profit regularly. I want to make sure my buying power stays pretty large. So I still have around 30+% of my account in cash that I'll hopefully continue to deploy as needed if I need it, when I need it. What are your thoughts of the possible government shutdown? I thought they voted for an extension. Didn't they pass it already? Trump says U.S. government shutdown would delay his planned tax bill. Trump backed stopgap bill as shutdown deadline. When was this? Yesterday? Oh, stopgap bill as shutdown deadline fear or nears. Let's see. Democrats huddle for hours on Wednesday, plotting a course forward on stopgap funding to pass by the Republican-controlled House, with only 2 more days remaining for a partial government shutdown to be triggered. Gotcha. So you're going to go to shutdown next week. In a game unlikely to succeed. 1 month extension of existing spending with the aim of providing to complete comprehensive appropriation bills for this year. So 47 senators unified in opposing a 6.5-month funding bill passed by the House, and only one Democrat voting in favor of it. I still think Republicans will pass it. Blocking the bill would require at least 41 of Schumer's Democrats to vote against limiting debate on it, which would stop the measure dead in its tracks and could lead to a partial shutdown. Okay. I mean, another reason this market would probably just have more pressure on it to the downside. Government shutdowns, probably not a good thing. Usually, yeah, I mean, I don't think the Democrats can do themselves any favors, to be honest. It's like if you are, the market right now feels like it's kind of on the brink, right? We're down 10% already. We've had a correction that was necessary, but now it's like all the worry that we've climbed through 2023 and 2024 is now just sitting there and swelling, right? So you take slowdowns to Doge, to tariffs, to concerns, to credit card debt, to spiraling debt, to now add government shutdown to it. If that's the case, so it's just like, man, when it piles in, there's no stopping this market when fear is really, really bad, right? So I think if the Democrats want to play hardball and they're gonna toe the line, and this market takes it harder, I think Democrats are gonna, I don't know, they might pay for it when it comes to midterms in 2 years. So I think in typical fashion, they should find a way just to, pass a stopgap. Even if they go by 6 months or 12 months, whatever they can negotiate. I mean, my gosh, do something bipartisan. That's what's the worst about politics right now, is like you dig your heels in so deep that it's like there's no going over or against party opinion. If you, I don't know, I can't believe this is how we've been. It seems like we've been that way for a while, but anyway, it's just a power struggle. It's always a power struggle. Democrats have the minority, and so they're trying to unify and toe the line, I guess. But I don't know. Yeah, Carla, that's true. I'm just going after those are some short-term opportunities. Those are the best ways I can price it out to give me a good probability of profit. So, everything is so aggressive right now that premiums are just high. I mean, with this type of volatility, when you've got ranks in like the indexes themselves, like a SPY is trading at 54.2, your call options, your put options, like everything is more expensive. So, I mean, I can still trade spreads and whatnot, but volatility is just really, really high right now. We're getting some wild intraday swings. I mean, even looking at some of these intraday movements we've had point wise, I mean, that's 130 points in the S&P. That's 13 to 14 points on the SPY. Your Qs, I mean, we've had days that are probably in like the 15 to 20 point days on Qs, probably over 200 to 300 points. I mean, this particular day, this was Monday this week, just intraday trading, the market had a 15 over 150 point move on the Qs and NDX. And from the actual sell off from Friday's close, I mean, that's a 23 point move on the NASDAQ. So, yeah, I mean, we're getting some expensive trades. And, Carla, if it's that expensive, don't take the trades. There's still going to be plenty of alerts and double up alerts. You should never be taking trades that are too expensive. So if you're not comfortable with the risk, don't take the trade. Okay, there will be plenty more alerts ahead. I don't want them to be expensive, but I'm pricing them out where I feel like we have a good probability into the trade. All right. So all this being said, could we expect a correction? Sure. I still think the market with some of the overextended moves, a pullback would be nice. If we go into, avoiding a government shutdown, that would be nice. If we go into having some lesser tariff drama in April, that would be nice. So, I mean, anything that gives this market a chance to lift off. I think that the Fed is going to be very cautious next week. I think Powell will still say the same thing. I don't think they're going to surprise the market with any type of rate cut. So I don't know why the market would be expecting a rate cut next week. It's been, forecasted and premeditated for months now that they're going to do nothing in March. But the probability is now that they would be cutting in June and September and the end of the year. So looking at about three cuts by the Fed. and maybe Powell will give some commentary on it. Why they're waiting, what they're noticing, I don't know, maybe their uncertainty about the impact of tariffs. So we'll see. But I mean, on a positive note, there are a couple things that are good right now to build in some resiliency to the market, and that would be that there's still $1 trillion+ of buyback potential in the stock market, which will stabilize stocks a little bit. There's still a Fed that's sitting at 4.25%, 4.5% that still has room to actually cut rates, right? This is different than COVID. This is different than 2008's financial crisis. The Fed had cut already down to near zero. So there's nothing they could do. So when the market's in a recession, there's nothing they can do. Now, sitting at 4.25%, 4.5%, the Fed can cut rates. So if they cut 3 times this year and they pull back into the threes, well, hopefully they're doing that without the 10-year, ripping higher, and without borrowing costs going higher, without our inflation prints going higher. This week, it was nice to see that inflation was not another drama point on top of everything that's causing this worry right now. Okay. But if the 10-year is going to go down, I don't know if that's a good thing for the market. We might continue to see yields going down, bonds going higher. The break between bonds and equities, that high correlation around 0.7 is starting to fade, which it was a needed break. We've already seen bonds for the year. Let's go to, TLTs, your long-term bonds. Go to the beginning of the year. Okay, there's still a ton of indecision here, but rather than being down 10%, right now, we are at the lows of the year. So we had closed last year into the open this year with a gap higher, and bonds are up around 3.7%. So you have the 12-year or the 12-month bond at 3.7% year to date. Meanwhile, you have about a 10% correction down. This would be TLT. Your SPY, this would be year to date. SPY. It's not actually down 10%. That's just the high to low, so that's our correction. And then you look at the QQQ. So I'm just going to throw these numbers out there. Like, we're in correction in S&P, correction in NASDAQ. Bonds are hanging in there with green. They're green on the year, one of the few things. Cash is okay at short-term treasury rates. So if you ever trade, this is one thing I trade quite a bit on Tasty Trade, is it's SGov or BIL or SGov. These instruments are a place that you can actually put your money in for the like the 1 to 3 month treasury yield. So right now it's about a 4.3% yield. So if your cash is doing nothing other than sitting in BIL, you're going to get about 4.3% cash, which isn't awful, but I still want to make sure that I'm investing. Okay. All right. So there's some ways. Go back to the daily chart here. I mean, this could be an interesting breakout in bonds. I have a covered sell side on TLT. I think it's at 92 until I closed out for profit. Let's go TKO, fine, TLT. So the 65 by 92, this is out to April. Right now it's up about $1,200. And interesting. So my 92 call is only up about, it's actually not profitable. So my 65 call is profitable. My sell side is not, because we did have that aggressive push up, but this is going out to April. This looks like we could be forming a head and shoulders. It's not a like perfectly awesome textbook head and shoulders, but this recent high breaking this trend line, could the market be setting up for a head and shoulders rally? If so, TLT is a good place to be. I mean, I think there's room on TLT to get back into the high 90s or maybe low 100s. And if I get called away at $92, I'll take my profit, but I'll still be looking to kind of scalp directionally here. So bull call spreads might not be a bad trade for 2025, especially if there's a continued disconnect between stocks going lower and bonds looking a bit more attractive. So I'll keep an eye on that one. The 10-year, as we talked about, it's kind of pausing here between 4.1 and 4.3. I think more downside in the 10-year is going to be met with some or correlated with some pain in the stock market, right? This decline in the 10-year has also faced decline in the stock market. So if we're going lower in the 10-year, I think that's facing lower lows in the stock market. So, I mean, those that want, and like I said, I'm one of them, I want a lower 10-year, but I don't necessarily want the lower 10-year to come at the expense of a just beat up stock market. So I think there's opportunities ahead, but man, I don't want to see, I mean, I'd love to get, 30-year mortgages back down to whatever, 5% if possible. That'd be great. But we're trading around 6.5 right now. I think 6.5 is about the average 30-year. I'd like it to be better than that. We're trading at 6.65 for the average 30-year right now. So if it slides lower, does this get back down to like 6%? Maybe. And if the Fed's looking to cut more, I mean, I'm not sure. So something else to consider out there. Futures market, I haven't looked at futures in a minute. Bond futures. Yeah, this one looks pretty good for head and shoulders. This is left shoulder, head to neckline, right shoulder. If we break this neckline, ZB could continue to look pretty darn bullish. So I may look at this might be some scalping. This might be a good hedge. Let me see how far I can go out on ZB. I don't think I can go out far enough. If I'm going ZB for futures, how far out can I go? Only out to August? Yeah, I'm better off doing something on TLT, which is what I'm actually doing. So it's okay. So the way that I'm protecting portfolio would be I have hedges, which are mainly bear put spreads, and it's index related. I'm long bonds. I'm also long the Japanese yen through FXY, and I'm also in diversified sectors. So I'm in healthcare with a couple of plays. I'm in energy for a couple of plays, and the staples for a couple of plays. So it's not going to be it's not going to be perfect, right? But this doesn't suck. It's not like I'm just fully tied to, the S&P's down, I can't make a single dollar. I mean, no, there's still plenty of profits ahead. But I want to make sure that in the bigger picture, I have some form of protection against the broader market. Broader market can do whatever it needs to do. What I did say this year is that I'm not trying to be a aggressive stock picker, simply because if we have a broader market down, if the S&P is down, there's nowhere to hide. Bonds might be up, but they could also be just as ugly. This is what 2022 felt like. Bonds were down in a bear market, in a big bear market, and stocks were down in a big bear market as well. So that's the hardest, is when bonds are down and stocks are down and currencies are maybe your only play. The only way to hide out would be, hedging through the FX market. Also not easy, because your strength is going to be probably coming in the Japanese yen. Strength is coming in maybe the Swiss or the dollar. It just depends. I mean, those setups are few and far between. They all depend on what the flows are. Okay. This is Australian dollar futures. This is a lot like looking at the Aussie dollar. Euro futures, we had that huge rip. The dollar's been falling aggressively, and I still think there's room to fall. I mean, another spot to watch for would be DXY. If DXY has a pullback here, I think it's going to be met with some additional pressure. I wouldn't mind seeing the dollar get weaker. I think that this area is a great spot to be looking to get long. We had a really nice squeeze on the dollar back in September of 2024. What goes up, I thought would come back and find some support and maybe see a range on the dollar. But no, we are seeing the dollar drop quite hard here. So I still think the dollar can fade. This to me is a pretty attractive level to be looking dollar long, and we just continue this game of range. Support, 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 support. And this is farming some uglier highs, but maybe just more range bound trading on the dollar index. Randy, good work, man. 4 for 4 on daily profit play. Love it. I think we're 20 for 21 this week. I posted this in my Telegram yesterday. We got newsbreakers 17 of 19. We're going to go 18 of 20 because Adobe is looking good for profit by expiration tomorrow, so that'll be an easy win. So that should be 18 of 20 on newsbreakers. And for the last couple weeks of trading here, this will be 20 for 21. I took another winner today on daily profit play. So worked out pretty nice. Pretty nice. Oil. Oil at 66. I don't feel comfortable saying this is a bottom. I just don't think it is. So I think, again, lower inflation, lower energy prices, that's probably not going to suck too bad. But again, like overall slowdown, oil prices drag, we will find out. But if this is heading lower, I'm not calling the bottom here. So I'm out of CL. I do have a trade on natural gas. This one's out to 2027, so I'm not super worried about it. Let me see what my call side is. So right now I'm up on this one, $23 sell call out to April. So I'm up $429 right now. And I think my max profit is around $700. It's like $675. So if it doesn't get called away above $23, then I'm just going to sell another call against it, try to lower the cost basis for my debit. And my debit currently is $11.23. I'll try to lower it down to maybe $11, maybe $10.80, $10.70, and still look at similar upside. Gold. Gold just made a fresh all-time high. Wow. Okay, now let me take a quick peek at gold from this lens here. Okay, gold. I guess I'm going to add that to the list of hedging too. I mean, I'm long gold, and that's not been a bad thing. Have a look at this. There's a couple ways to watch this. I'm a little cautious on gold. And again, I don't mind the run. I don't mind the run to the upside. I'm bullish on gold overall, but I'm watching for this potential higher high in price to be, I mean, I don't know. Is this a hidden bearish divergence where we had overbought conditions as it was climbing? But I guess we're still above the 50 line in the RSI. So let me take one more workspace and look at gold. I mean, I pointed this one out. I just think that gold needs a pullback. And I don't want to call the top. I don't want to be bearish on gold, but I just think we need a pullback. So gold here has lots of demand zones lower. On the daily time frame, we do have some overbought conditions. And these are worked out somewhat nicely in the near term. Like that was overbought conditions with divergence, and gold did pull back. Overbought conditions with divergence, gold did pull back briefly. The one thing I keep watching is the percentage away from the 200 moving average, and not just the percentage away now, but also the time away. So gold has spent a lot of time. Where's that fib? Okay, so the last time that we tested was 364 bars ago. That's a high bar count on gold, if you ask me. Let me see something here. Oops. That's a double up. That's a double up. That's a double up. 111s. This one is sold to put. I mean, 98% chance of profit. I've collected about 51% on that put. I sold this when the Ivy ranks were up in the 60s. I just went out to June, went out about 100 days, and sold like I don't even know what delta this was. Maybe like a 10 delta put, something ridiculously low, and collected $567. So hopefully this will just be easy. I mean, and if I was going to own the SPY at 430, I would freaking sign up in a heartbeat. But that's going to be a lot of pain if I was like, yeah, I'll own it there. So anyway, we'll see. All right. So back to gold. We've got a really high bar count here. I'd said this last week. If gold makes a fresh high, I think this could be a bit of a trap. Hidden bearish divergence. We're making a fresh high in price, and we have no momentum that is agreeing with that. So like up here, when we're getting higher highs and you're going higher in momentum, we're still carving out those highs. But as soon as you make a higher high in price and it disagrees, the market went sideways. Okay, same thing here. Higher highs in price, you're getting disagreement, and the market actually corrected. So I think making a fresh high in gold with no momentum to show for it, and also relative strength showing some hidden bearish diversions, I wouldn't be surprised if gold is going to pull back. Okay, now this is an interesting trade. I would be a little gutsy if I said, hey, you know what? I'm going to call the top on gold. But I could structure a trade in a way with gold futures, maybe micro gold futures, so I can not make it, let's go GC, micro gold futures. So there's no options on micro. That sucks. So GC for gold futures. If I went out to 42 days and I said, okay, fine, I'm going to buy this, I'm going to sell this, and then further out of the money, I'm going to see if I can turn this into a kind of a call condor trade. There's a couple ways I can do this. I will price this out either at the money and see if there's enough premium here, which there might be. So let me find out. Get this option chain to expand. Now, this is a trade that I don't really want to take more than like a 0.5 to 1% risk on. So could I do a 32.20? Yes. Now the key here is I'm going to put a spread in this to make it a credit trade. So that trade pays me 80 bucks. This trade pays me $1.70. This is taking up just less than 1% risk in the trade. So I can get $170 income. I also have a potential profit trap of $660 if price is bigger than, let's say price is greater than this level by April 24th. I can get a profit trap in here. Let me see if I can build this one out in the, can I go analysis? Nope. Curve. Ah, fudge. It's like, do I need to take the trade? Analysis. There we go. There's the trade. Okay. So current price of gold would be here. It might be somewhat difficult to see this, but let me know if you can see this okay. So we're trading at $29.95. That is current spot price of gold. Okay. So I would get, let's say $1.70 is credit. If price goes up a little bit, price goes down, I still get $170 income. All right. Now, if price continues to go up higher and we get into this area, well, this is a $500 profit trap on top of the $1.70. Now, the nice thing about this trade is I can maintain that profit trap all the way up here until around the 32.20 to 32.25 level. Okay. Which tells me that would be gold having to go up, not just now, but gold would have to go up another 7%, another 7 to 7.5% to the upside. It can happen, okay? But the probability of that happening is pretty slim. This trade has about an 88% chance of profit. If I wanted to make this a little bit cheaper, it's a little bit cheaper that way, $1.80 credit now. See if that's any better. Let me go to like the 30, I don't know, let's go 30.90. It's a little bit better. So now I've got a profit trap and collecting a little bit more income up front. So maybe I can pull in. If I pull in over $2, I think I'll take the trade. Okay. So 220. See what this one trades for. If I can get over $2 credit on the trade. So probability profit 89%. This is a 15 delta. If I wanted to go a little bit further out of the money, it's going to lower my overall trade, 32.50 to 33.50. I don't want that much risk. Okay, that's about a 1% risk, $130, $630 profit trap. Not bad. Now I'll go to a 91% chance of profit. Doesn't take up a lot of buying power. I'm still long on gold as well. So I mean, if I somehow didn't win on this trade for the income side, 32.50 is it's way up there. I mean, we'd have to go 32.50. I guess, look, we could have, I don't know, we could have like some freaking outlier thing on gold. It'd have to go up 8.85% and do so within the next, 40 days or something like that. So according to the options pricing, I mean, a one standard deviation move, expected move is maxing out around 31.50 to 31.55 if it stays directional. So I don't mind the trade. So okay, here's the deal. If I take the trade, I'm looking at about a 1% risk. Income is $1.30 with a $5 profit trap. So why am I taking this trade? Well, I'm basing it on the percentage move away from the 200 moving average plus the time away from the 200 moving average. And I think we have a lot more disagreement here on the trade. So could we get back to overbought conditions? Yes, but this thing would have to run like capitulation, like very aggressive capitulation if that's the case. So I'm going to take the trade. So for $1.40, let me see if I can get $1.50 on this trade. That'd be lovely if I could. $1.50 not filling. So $1.40 is the mid. $1.40 not filling. I can't go $1.35. Nope, only increments of 10 cents. So $1.30. Come on, dude. All right, just got filled at $1.20 on the trade. So $1.20 on the trade. And 9732. Filled. It's going to get a couple of these accounts with this trade in. 7634. Take a look at that one. That takes up a little bit more buying power. 1608. Not bad in this one for income. Okay, I'll do this one on a slightly larger account. There we go. Okay, so that trade is in. So that's a trade on GC 6830 9732. So it's an April 24 expiration. A buy 3080 call, sell 3085 call, sell the 3250 put, and buy the 3290 put. So $1.20 credit. I have a $5 profit trap, and I've got about 3K in risk. What's my max risk? 3380 in risk. And it has about an 89% POP for right now. Okay, so that is the trade. I'm going to get that one posted. So I'll consider that one a futures trade. Going April 24th expiration. Buy the 3080. Call. Sell the 3085 call. Sell the 3250 call. Did I say put or call? They're all calls. Buy the 3290 call. 3250, 3290, and $1.20 credit. So $1.20 upfront credit, $5 profit trap if price is greater than 30.85 at expiration. 89% probability of profit. $33.80 max risk. Gold is making fresh highs and likely pushing into round number target. The daily 200 EMA bar count continues to grow, now over 360 bars, and the percentage away is one of the largest stretches ever. I mean, that's really why I'm looking at this trade. I mean, if you go back to this 200 moving average, we don't oftentimes get, that's a move of around 14 to 15% away. And how far are we right now? Right now, with today's high, we are around 12% away. So if we get to 15% higher or 15% away, I mean, that puts us up into like the 30-20 handle, like maybe 30-20 to 30-30. That puts us about 15%. I don't see prices going too much higher than that based on what I've seen historically. So this move away was around 12 to 13%. This move away was around 13%, about 14 to 15%. So not very often do we see this crazy, ridiculous move. Like that was a capitulation move. I guess that'd be the concern. If we did like an 18% move, this thing just blew the tops off. But man, it's like, where does gold stop? I don't know. So I guess let me measure 18% and see if that threatens my position. I've got 3250. 3250, we'd have to go, I mean, my gosh, we'd have to go like 25% higher. So I think the trade is structurally good. I think mechanically good. 3250 is the position that I'm threatened. From the 200 moving average, we'd have to be 23, almost 24% higher than that, and do that all within about 45 days. That's why I'm taking the trade. Okay. All right. So I'll post this trade. I'll build this out and I put in the risk graph for it. I think I can just post it in. Let me go into GC 1, 2, 3, 4. See if I can get an image of this. There. So I still want to reflect that there's risk on the trade, right? So I have my bull call spread, which gives me the profit trap, and then my risk is way out here. So I wish there's a way that I could like work these numbers a little bit differently. But point is I want to see, okay, I'll let price ramp up a little bit, and that's my profit trap. So I don't mind. Look, I don't mind if price goes to 30.80, 30.85, 30.90. I just don't want to see price get above 32.50. Okay, so I'm going to post this trade. This is GC. All right, so this is live price. And this is my bull call spread. So the 3080 by 3085 is my bull call spread, which serves as my profit trap. And I still pull in a $1.20 credit on the tail. So $1.20 credit. So if price goes up or down, I keep my $1.20. Price goes up, I have my $1.20 plus my $5 profit trap, and then the risk is all the way out here towards the $520 mark. So here's my $1.20 credit there, and potential $5 profit trap. And I'll note here, risk if GC is greater than 3250, which is quite a ways out there. Okay, so that is going to get sprinkled into here. Project options edge. GC, so gold futures. And then post the picture of that. So this guy post here. Trade is in. So hopefully it's just an easy trade for 120 bucks, but if gold is going to rip higher, I don't mind taking the $5 profit trap as long as price stays below 32.50 in the next 40 some days. We have potentially a trade of $620 per contract. So, and again, I'm trying to like gold would have to do something outlierish, right? Like literally, like man, this thing has never been 20+% above the 200 moving average, and I mean, brace for the downside if that's the case. If gold just gets ripped, it's like if gold is moving and performing like Bitcoin, for crying out loud. It's like that would be insane if gold got that type of a bid. So I don't think that's going to be the play, but that's why it's still defined risk at the end of the day. It's a futures market. I don't want to have any undefined risk. I think that's the worst case scenario. So I'm only going to risk about 1% on the trade. Okay, that's my max risk. And the probability of profit is around 89%, which I'll take that trade. And if I'm right, cool. I'll just make the money. If I'm right with a profit trap, cool. I'll make the money. Okay. Expiration date is 4/24. So April 24th. Yep. So that's out 42 days. So I just kind of went into that like tasty trade sweet spot where like they like the 45-day window. That way, technically since this is a credit trade, I'm getting I'm selling options here, right? And so I want that to be helping me where the time decay works fast enough where when the first about 21 days of trading, I'm getting about two-thirds of the time decay. And then the final bit, this is the type of trade that I don't mind it staying all the way to expiration, especially if it means I can get a profit trap out of it. Okay. All right. So posting a couple trades there. And now I'm going to be in GC. I'll mark that. That is all the way up here to, I'm just going to make a point of 30. Let's go 3085 or 3090. 3090, if it's above here. So above 3090, go horizontal ray at 3090. and below 32.50. I mean, technically 32.55 or 32.56 is going to be my risk, but this is going to be my sweet spot. So if price is in here, that is a winning trade. So GC, it's a call condor, kind of fancy. Technically, it's, I mean, I guess I can call it like a 1111, but whatever you want to call it. So that's the trade. All right. So where did we finish for the day? Telegram channel. My Telegram is right here. Project Options Edge is a bit of a discretionary service that I'm running. If anybody's interested in that, you can email support@prosperitypub.com. So this is a discretionary service where I don't really have a cut strategy, but obviously I trade whatever I think looks good. There's a variety of services that I run that are very mechanical and systematic, and I can take the same tile of trade all the time. This is more of like, look, I trade ways that I'm trading to make money. I will hedge in here. I will put in trades like this. I'll do some fancier, more advanced strategies. Not to make it confusing, but simply because I'm looking at this as opportunities to make money. So this is Project Options Edge. If you're interested, you can email support@prosperitypub.com. Okay, here's my Telegram service. It's free to join if you'd like to join my Telegram. And I've got a Discord as well, so just give me a second. I'll post it here. So this is Chris Pulver Telegram. And then my Discord, I'm going to put in like a 1 hour link since you're watching me live. Just because when I put it on YouTube and I go for like a 24-hour link or a 7-day link, I get a bunch of freaking spammers in my Discord service. So I want to edit that, and this will be good for the next hour. That way, if you need the link or want the link, you just have to send me a message on YouTube. So Chris Pulver Discord. Okay, if you join my Discord, make sure you read the rules. All I'm looking at is I don't send friend requests. I don't send direct messages. Everything I do is in the public forum. So the Forex chat, the free group chat, stocks, options, futures chat. When I go live on YouTube, when I post on Twitter, like it's all my content in one place. That's what my Discord is for. It's not for sub conversations and threads and this like web that is hard to manage and monitor. So it's just a free space for all my content with links, with services. But people come into Discord and they get private messages. They think it's me. It's not me, right? If you want to message me, you know where to find me. I'm in the public chats every single day. Okay. All right. On that note, I do have one thing I will share. Downloads. Let me go. Channel. Yep. Here we go. This is where you can find me. YouTube.com/Chris Pulver. YouTube.com/Financial Wars. When I go live, I stream on those channels. My Discord is Chris Pulver Trading. I just shared the link to that. My real handles, these are my authentic handles, Real Chris Pulver on Twitter or X, Real Chris Pulver on Instagram, the Real Chris Pulver on Facebook, and Telegram is just Chris Pulver, which I share those out individually, right? So anything outside of that, I'm not on WhatsApp. I'm not on some other BS channel that you think it's. Unfortunately, I'm in a space where there's scammers and imposters. So go to these outlets if you're interested and follow me. This is where I'm at every single day. All right. So this is where you can find me and only me. And all it is typically just live content, trust content, links. It's not it's not solicitations, it's not scams. Like that's ridiculous. And I hate the fact that I got to deal with that. But I put myself out there in the public and just deliver trust content and try to help traders trade. And unfortunately, there's people that scam that and take advantage of that. And it's pretty predatory out there. So just be careful on where you're following me because this is where I'm actually at. Okay. All right. And I ask everyone if you see anything suspicious, then post it in my Discord. Let me know. Send me an email. Contact me. There's ways to find me every single day. There's not much you can do. It's like I see fake accounts all the time in Discord. I see fake accounts on Instagram all the time. I have people tell me like, "Do you contact me on WhatsApp?" No. So obviously just use your head and use common sense that it's probably not me. Okay, that'll do it for today. Any other thoughts, questions? We good? All right, I'll let you go for today. Yeah, okay, I'll let you go. Have a good day. I'll see you tomorrow. Thanks, bye.